Welcome to Leaders in Lending. I'm your host, Jeff Keltner. This week's episode features my conversation with Michael Reed, the Chief Risk Officer at WSFS Bank. It's a really interesting discussion. Michael came to banking from being a lawyer and outside counsel to the bank and other fintechs and banks into the role of Chief Risk Officer. And I think he's got a really interesting perspective. He had a phrase I love to talk about how he thinks about risk and risk management, which is risk-adjusted rewards. It's kind of like risk-adjusted return, but how do you think about maximizing risk-adjusted rewards? How do you partner with line of business owners so they understand and can accept risk? That was a really interesting idea of shifting the responsibility of risk to business owners with information coming from the risk team. We talked a lot about the building of frictionless experiences. We make some comparisons to what's happening in the broader retail space to how that's impacting banks, and a lot of discussion about the future collaboration between banks and fintechs and how banks and credit unions can take advantage of what fintechs have to offer and what they really need to do to earn business and most importantly, customer loyalty over time. So it's a really wide-ranging discussion, but I think one with a lot of interest. So without further ado, here's my conversation with Michael Reed, the Chief Risk Officer from WSFS Bank.
Hey, Michael, thanks so much for joining us today. I appreciate you making the time.
Hey, Jeff, thanks for having me. It's great to be here and talking to you.
Yeah, I wanted to start by just having you give us a little bit of your background. I mean, I feel like most kids, I was asked this on a podcast, what do you want to be when you grow up? And I don't know anybody when asked, what do you want to be when you grow up as a kid, answered a banker. And yet here we are in the banking industry. So give you a little bit of your history of how you ended up, in this role at WSFS and how you got into the banking industry in general.
All right, happy to do it. So I'll say growing up, I grew up in Canada. I don't know if you knew that, but I wanted to be a ski instructor. So I'm like a long way from that at this moment. So.
You can do that when you retire too.
Yeah.
That's not a bad way to do it.
Exactly. One of my retirement plans. So really, got into it by accident. I moved to the U.S. Really with as a lawyer and really with plans to be here a couple of years and move back to Canada and not be a lawyer anymore, and ended up being here for 20 plus years. And joined a firm that did a lot of work with banks. So I just got steeped into the banking industry, and that bled into, quite frankly, financial services overall, and fintech companies. And then WSFS Financial has been a client of mine for almost 20 years, and we just found a way to kind of have a happy marriage. So it's been an interesting progression, as you sort of said, from lawyer to banker. But it's been great being in the industry for this long to see, even in 20 years, how much has changed.
Yeah, it certainly is never a dull moment, I guess, in the industry. Tell me a little bit about the role you have at the bank and how you think about, what it is, what your goal is.
Absolutely. So I'm our Chief Risk Officer, and so obviously manage our risk management group, which really supports the risk management activities throughout the company. Right? If you think about it, we're not here to prevent risk. We're here to provide I'll call it risk-adjusted rewards in our business.
Risk-adjusted rewards.
And so that's what we do. And then just given my background as an M&A, capital markets lawyer, and so forth. I also work a lot on our M&A deals as well as our fintech partnerships, like the one we have with Upstart. And it's interesting to bring that perspective of sort of risk management to it, because at the end of the day, we're obviously driving towards revenue and income generation. So you don't want a risk management issue to get in the way of that. But at the same time, I like the word risk-adjusted rewards, because that's what I ask our team to focus on when we're balancing risk and reward.
I love that phrase. I feel like I always say this about counsel, so I appreciate that you came in as a lawyer. But some lawyers feel like their job is to tell you no, and some feel like their job is to give you counsel about understanding the risks and allowing business owners to take decisions about what risks are worth it, and lay out for me the groundwork and the landscape of what's out there. And sometimes lawyers have to say, no, you can't. There's no going to jail kind of rule that we used to have. But I feel like that idea of how do we find a way to and understand the risk and measure the reward is a pretty different approach than you often see in particularly bank risk groups, where they feel like the job is more eliminate risk versus manage, identify, and kind of hold risk into the right level given the rewards there. So it's an interesting approach. I'm curious how you think about driving that mentality through the team. I think there's this big difference often between understanding the changing nature of the risks that are out there and how you manage them, and then having a team that's been steeped in a different way of thinking for 20, 30 years, adjusting to a different approach to managing risk?
It's a great question, and really it's kind of bringing my approach to being an outside counsel, like you described, to it, right? It's my approach always was, let me give you the framework of what the risks and the opportunities are. I'll also tell you what I think you should do, but it's your decision at the end of the day. And it's really getting on for the risk people in particular. I'll kind of do it twofold. You've got the business owners in a bank, and you got the risk people, and it's really getting the risk people to say, hey, we're going to be partners with the business owners, and tell them when they shouldn't do something, but we're otherwise going to try and find a way to yes, right, and get to that yes answer at the end of the day. And then you've got the other side of it when you're talking to the business owners and you're saying, hey, we're not no people anymore. We're like, yes, here's how you get there. And instead of waiting till something goes wrong and then asking us how to fix it, why don't you come to us up front, because we promise we're going to help you get to yes if yes is the right answer. And so that's a cultural evolution, right? But once you kind of start that dialogue, it's amazing how quickly, because people then see the opportunity, right? The risk people see the opportunity to drive some value from a customer service to the business owner's perspective. And the business owners then start to see, hey, actually, we have partners here that want me to do well in the business, and they're going to protect me from the real downsides.
Yeah, I think it's also powerful when you actually put truly the risk acceptance in the hand of the business owner, right? Often you think the business owner goes, I'm going to push whatever I can get through the risk group, right? If they say yes, and we're just going to push, because that's their job to stop risk and my job to push the business. And when you move that no to the business owner going, hey, I've been told the risk and I have to make a calculus, and it's my job to accept the risk or not, knowing what has been laid out. It's a really different mindset, both for the risk partner, but also I think for the line of business executive who's got to now understand and accept it and kind of own the risk that comes with certain decisions and the reward, but to be making that trade-off, on the business side, as well as having it just be did risk sign off or not?
Yeah.
Did I get a green light or a red light? Is a kind of different mentality.
Yeah, can I give you a quick example of that? It didn't play out here at WSFS, but in my sort of prior life, I was in a board meeting, and we were sort of walking through. They were in a tough situation with their regulators, and sort of walking through how they had to change their risk culture to make sure, just what you were just saying, that the business owners understood that they owned the risk at the end of the day. And the nameless executive at one point said, so what you're telling me is I have to own the risk? And we're like, you own the risk every day. So, but to your point, it's just driving that mindset to understanding, okay, hey, I own the risk, and now I've got partners over here that can help me figure out how to make an informed decision.
Yeah, that's why I always love the descriptor counsel for my attorneys. Is they're there to give counsel, to help identify, give advice, give the risk, and then you as a business owner have to ultimately make the decision and own the decision, including the risk that comes with it. Exactly. That's maybe a different mindset. I'm curious, do you see a changing shift in the nature of risks that you have to manage, particularly as you move to more digital delivery, more maybe partnerships with technology companies? What's changing about the nature of the risks that you're most worried about, or the things that you have to manage and think about? Well,
an easy answer is just cyber risk overall, right? I mean,
Sure.
That's sort of an
see
easy,
it every day.
Yeah, exactly. It's an easy standard answer, and it's real. So I mean, but to go a little deeper on that, for financial institutions, it's understanding where your gaps are as you transition to more automated processes from manual, human-driven processes, and really trying to identify those gaps, because it's new learning, right? Like before, if it was all manual, you kind of knew, okay, there could be human error, the handoff here could be wrong or something like that. Now you've got a lot of automation, you still have some human pieces to it. Where are those gaps? And I think that's where the shifting sands of risk are going, is the new learnings on identifying gaps between the technology piece and the human piece, where there are those.
Oh, that's really interesting. It is certainly. I love that concept of moving to automation and how there are different risks. And I do also think it's important that people remember how to keep in mind, like, how do you compare those risks versus the non-audited? Because they're like, it's not like one's riskier or less. The nature of the risks are different in those two places, and you've got to change what you're worried about in some ways as you go from humans to machines doing things.
Exactly right. And then I'd say on the other side, just because, upstarts of fintech is it's and you can speak to this obviously better than me, but it's fintechs also understanding who are always striving for the best technology and automation and so forth, understanding as they try and partner or deliver services themselves, understanding where their risk gaps are, because there's always going to be that, and as from AI to even RPA, as RPA processes increase automation, there's still always going to be risk. It's going to be harder to identify them, and you're going to have to identify them faster. And it's that sort of, hey, we got to change our risk gap review cycle.
Yeah. How do you think about the partnerships with fintechs, and not just from a risk point of view, but it feels like, fintechs are they friend or are they foe? Maybe a little bit of both. Like, how do you see that evolving relationship between the fintechs out there in the world providing consumer services, providing services to banks, and what banks really at a core do, and what maybe banks can learn from the fintech space?
It's a great question, and they are a bit of both, right? They're both friend and foe, and I think that's great. Banks compete with each other. They need some competition to evolve as well, and that's what we're seeing happen. And so, I think as much as banks 20 years ago or 15 years ago, before you kind of called it fintech cool, it was business services. They'd say hey, they need us. Well, guess what? Banks need fintechs more and more now, and that's kind of where I see this changing and really from the perspective, Jeff, I mean, we could take 4 or 5 different perspectives. I'll focus on one for a second in the consumer space. Delivering, sort of the omnichannel, frictionless customer experience. Banks, they're good at high-touch human interaction service. That's what they've been doing for hundreds of years. But in a world that's moving at a different pace, when you got customers who have different ways of shopping, and just as I was saying earlier, you liken it to general retail for a second.
Yeah.
Banks don't have the capital or the time to invest in the digital, with the exception of the big banks, digital delivery of services, digital customer experience. So I think banks are going to have to rely on fintechs to do that. And then, by nature of a fintech, at least at the moment, their primary customer experience delivery is not human interaction. So when you need both of those, that's where you find, I think, a good marriage.
Yeah, I think consumers really do want both in different instances, and so it's really important that you find a way to. How do you think this idea of frictionless process, I think, is really interesting. How have you seen the execution of that, or the mistakes that maybe are made as people think about the shift to digital? And I feel like there's this big difference between what often is digital transformation and new stuff I want to do, and what is really delivering that vision of frictionless, which can be. I talked to a bank that said, we've got a digital loan. I said, great, you have to come into the bank to sign it. When you're done, you come in and sign in the branch. And I went, hold on a minute. And so how do you think we're doing as institutions on kind of the focus on delivering frictionless versus maybe other, short-term wins or digital focus or things like that?
I would say the focusing on just financial institutions for a second, the ones that are doing it exceedingly well are basically looking at like a digital transformation from end to end. It's human nature for us to always look at the next new shiny object, right? And in my example, or what we're talking about here, the new shiny object is the front end of the house, what the consumers see and so forth. Like, oh, that's a really cool website. That's really cool how you can click through and see your, loan choices, for example.
Yeah,
that sort of piece. But then when they decide they're going to, when the consumer decides they're going to purchase that product, if you haven't thought through that entire process and tried to automate that to make, just to your example, right, have a digital signature at the end, let alone all the processes and procedures required or otherwise that you need to go through, it's not going to make that experience great, and it's not a true digital experience.
Yeah, I think that's such a truism. By the way, it's not just financial institutions. In Silicon Valley, all the time you hear shiny object syndrome, where people want the sexy new thing. They want to release a new front end UX. It moves in real time, whatever. It's got some fancy whiz bang feature, but then that's not the thing that actually ultimately often drives value, which is simplifying a process, making something easier. The back end infrastructure. So yeah. I think it's a really interesting thing. As you think about that frictionless process concept and kind of delivering great experiences, how do you think the nature of loyalty, like a consumer, are they coming to one institution for lots of products? How do you earn the right to serve them on a repeat basis or across multiple products? Versus I often used to say that it used to be, relationship in real estate. Literally, like the branch that was closest to me is where I went to do the stuff. I was actually reading the news this morning. They said it was 82 was the first debit card coming to Canada, which is it feels like that's the oldest thing in the world. And then that's not that long ago, right? In some sense, that where you had to actually physically walk in with the check to turn it into cash, right? And so you always went to the same place because that's just how it worked. Now you don't have to. How do you think we earn the right for customers to come back and be repeat users of our services in a world where it's not based on the branch I always walk into because I know the parking lot and I know the guy behind the counter?
Yeah, that's fair. It's a great question, I sort of liken it a little bit to retail, right? Do you go? Mm-hmm. Do you shop at the same grocery store, and why do you do that? Or do you shop at multiple grocery stores, and why do you do that? Or a hardware store or the like, right? But yeah. I think, to your point, I'll just go back to what I was saying. It's delivering consistent customer service first of all, right? Like if someone has that great experience, whatever the delivery is, whether it's through human interaction, mm-hmm. whether it's purely online or it's hybrid, if they feel like they got a great customer experience, you're going to be at the top. That's the brand loyalty piece. You're going to be at the top of the list. And I think the second thing is making the customer feel like they got value, right? And it's not just always about dollars and cents at the end of the day. Did I get some value for this? So having a frictionless experience, meaning not just technology, not just human, but figuring out how to kind of marry those things together so that when the customer wants, when they think about the grocery store, if they want to go into the grocery store, they might want to go on their own, find their groceries, do self-checkout and leave. They may want to stop at the butcher and ask, what's a good fish for me to cook tonight, right? So you got to be able to find a way to drive value in multiple different ways. That's why I like the omni-channel sort of view of things, but make mm-hmm. it as frictionless as possible so that they can choose how they want to purchase a financial product, when they want to purchase it, and how easy is it. And that to me is, people don't think of it as value, but I think it's value, right? And value then drives loyalty. Mm-hmm.
Yeah, I think applying the concept of frictionless to human interaction is really fascinating because mm-hmm. we right now put a lot of friction in human interaction in terms of IVRs or lines or whatever. It's it's hard to get to a person, and mm-hmm. applying the concept of frictionless to a digital experience where there's few things to do, but also to a human experience where it's as easy as possible to get to the person with the knowledge that I need is actually a really interesting paradigm.
It is, and that's where I think, especially, and I'll move away from consumer just for a second, but in the small to mid-sized business world, that's where branches still play a role in my mind for banks, right? Because not everything those businesses need can be done online. Like transactional, they can do their transactional stuff online. They don't need a for that. But they sometimes need that trusted advisor. They need that, hey, I need something new. I can't really figure out what it is. And being able to either pick up the phone or walk into a branch, and I'll throw the digital out, right? Schedule your appointment online so you're going to get a person right away. Like that to me is where you can find that frictionless human experience because you get to them, right? To your point, you get to them right away. You're not clicking through, waiting online, all that kind of stuff.
Well, it's interesting you put that in the context of small, medium business owners, but I find consumers are the same. I mean, they got transactions they want to be easy, but the level of financial sophistication of most consumers, or understanding, sophistication is maybe too judgmental of a word, but the understanding of the breadth of financial products and how to pick which one might be a fit for them. I want to retire, like, do I have a 401k at my office? Do I want an IRA or a Roth IRA? Or like, do I want to put it into an index fund? Or do I want, like, what do I do with them? Like, that's hard. Or even just a mortgage. Like, do I want a 15 or a 30? And, what is this, like, what is the difference between a 15 and 20, a 25% down? Why? Like, those are hard choices that I think most consumers need someone to help walk them through. And that's a huge opportunity on the human side to provide real value to them. That's not just a digital experience.
And that's an excellent point. And that sort of goes to the other point of, you can read all you want online, and we'll just for the sake of our podcast here agree that what you read online is accurate and so forth. Like at the end of the day, you can read online, but talking to someone to kind of get context and perspective when you're trying to make those life choices and those financial choices and so forth is invaluable at the end of the day. And so I agree with you. It's a marriage between these different types of delivery channels, but I think it's also a marriage between fintechs and banks and how they kind of package that together for people. Quite frankly, I mean, a little bit maybe a pie in the sky, but to do some good in the world, right? Educate people and help them, achieve what they want to achieve.
It is maybe one of this is going to sound wrong, but my biggest surprises coming into banking, because as a technology guy, you think of banking as a numbers industry that's focused on outcomes and profits and whatever. And the mission orientation of most consumer banks around helping their customers, both small businesses, their business customers, but helping consumers achieve their life. I don't think it's appreciated enough outside the industry how much that is at the core of what drives most people in the banking industry day to day.
I'm glad you said that, because it is absolutely true. And having been in the financial services industry, you hear it, you talk about it, but then being a quote unquote banker, I mean, people here live it every day. And when I talk to peer bankers and so forth, if it's not the first thing we talk about, it's close to the first thing we talk about is like what you're doing for your community, what you're doing for the people in your community and so forth, and at the same time, running a business, but the mission, as you said it so well, is really helping people achieve their goals. And it is sort of the lifeblood of the sort of community bank industry.
Maybe we did all grow up wanting to be bankers when we watched It's a Wonderful Life.
Yeah, exactly.
I want to be a little George Bailey in there.
Yeah.
I did want to go back to your comment on frictionless and just ask you this from a risks point of view. I mean, there's this I think this really interesting balance between removing steps for a customer to achieve an outcome and the risk that's associated with, just take how many things do I ask for an ID verification or an income verification? Where I can automate that and reduce the friction, and there's this kind of balance with risk. How do you think about that paradigm? Because it's like on one side you're pushing towards ask for less stuff, automate more stuff, simplify process, reduce friction, and then there's like risk, and there's real business benefit to one and real risk on the other. And how do you think about kind of the balance of those two things?
Well, I'll go maybe not exactly where you were going, but how I think about it is, all right, what is the highest risk and the worst outcome related to a risk, right? So your highest risk isn't necessarily always your worst outcome, but what are those two things, first of all, and how do we address those in whatever process we're doing for a product, right? And then from there, all right, how can we make that process better without it increasing the risk that we already have there, right? So to your point, like, whether it's customer identification, taking the picture or whatever it is, it's think about what your highest risk is and what the greatest loss is related to a risk. Take care of those first, improve the process, and then decide if some of the other risks are worth taking or not. And some of them are and some of them aren't. And that's how you kind of improve your process. And I don't want to say automate, because sometimes it's not automate, but you improve the process, driving towards less friction.
Yeah. And I think automated processes are interesting in that they have, I'm curious your thoughts on this, this interesting nature of ability to identify and resolve issues quickly. So to your point about like, what's the worst case? How bad could it get? Well, sometimes I can fix them quickly, but they also are like operating at scale. So they can also have the other side where like, if this thing is wrong, so I think there's part of risk mitigation. It's like, how quickly can we see and stop and respond to issues in a process if we're seeing, I think about this for cyber attacks, or I think about it for, money laundering attacks, where it's like, do you need 100% prevention, or do you need to like, hey, we can catch something really quick where somebody's, and we're catching it, maybe not here, but before the final step, we can kind of push things off and feel pretty confident that we can put a stop to things. And that's interesting because it changes the nature of versus having to train a whole bunch of people on a new process, and how long does it take to roll out, and how quickly could you notice if something was going wrong.
Yeah, well, and that's a great picture of what I was saying, right? Is where in that automated process do you want to be in terms of identifying the risk, resolving the risk? Are you trying to identify and resolve every risk, or are you trying to identify and stop your greatest risk first, and then go from there?
Or the one that can be the most damaging.
Exactly.
There's that kind of interesting calculus of likely to happen and bad if it happens. But you got to like, a little multiplication there to figure out where your real the greatest threats really stand.
It is. It's like in the credit world, probability of default and loss given default, right? It's those two things.
That's right.
So
just with a different lens on it.
Exactly.
Well, Mike, before I hop to my closing questions, guys, was there anything you expected to ask or wanted to talk about that that we didn't cover, or anything else you wanted to kind of go over?
No, I don't think so. I think what we were talking about is sort of where I thought we would go today. It's been a fun conversation overall.
Good. I like when we meet expectations on where we're going to go. Well, I do have the standard 3 questions I use to close this out, so I'd love to get your take. Number one, and I think I'm very interested in your best career advice you've gotten, because you've obviously had an interesting career across different countries, different professions. So what's the best career advice you've gotten?
Well, like a true Canadian, I got to give you 2. So, but I'll go quick. The first one is your best investment is people, and to me, this other one goes hand in hand. Is never be afraid to ask the question. And so, to me, if you're investing in people, you're always learning from them as they're learning from you, and you're then never afraid to ask the question. And learning, to me, is what it's all about.
I got to ask a follow-up. How do you put into practice your best investment as people? I feel like that's one of those things that gets put on corporate, boardroom presentations. Our biggest asset is our people, but then like turning like what that really means to you and how you invest in people and make that a reality in the company, I think is quite different. What's your tip on how to actually put that into practice?
It's a great question, and it's really about prioritization of your time, right? And so for me as a leader, I think my number one priority is actually people, so I want to invest in people. So I set aside each week, a significant amount of my time just to invest in people that want to be invested in. And if you can prioritize that, and then figure out, like we were talking about risks, right? Like you figure out, okay, which things do I really never need to get to, and then what are the other things to get to? You will always find a way to invest in people.
All right, that's great. And then I actually love your second one. It's one of my favorite pieces of advice, because I cannot tell you how many times I've sat in the room and asked a question. It's great being in a new industry. Sometimes you have the ability to go like, I haven't been in banking for 30 years, so maybe I just don't understand. Like, can you explain this to me? And the number of times you do that where you feel like you're asking a stupid question everybody knows, and then half the people in the meeting come up to you afterwards and go, hey, thanks for asking that. I had the same question, and I just didn't want to seem like I was too stupid to know the answer, is incredible to me. And it's almost like a superpower to have no ego about just going, can I just ask this thing, because I don't quite get it. It really is an amazingly powerful tool.
It is. So in that advice, what I got was never afraid to be the dumbest person in the room. Maybe it's as simple as that. I'm like, okay, that's fine. I'll ask the question.
Get the ego out of the way and just admit to like, I don't understand this. I think it is a real superpower. And I find the smartest people are the ones who do that. Like the smartest people are the ones who are willing to ask the dumbest questions.
Fair enough.
First principles thinking. So my second question, what's the best piece of advice you've gotten around consumer banking or consumer lending?
I never stopped adapting and sharing. Like, it goes back to what I was saying about learning. If you're continually trying to adapt and you're continually sharing what you learn, I think you will continue to, grow, excel in the consumer lending space. And it is a community. It truly is. And I'm sure you've experienced that with Upstart. It's a community. So just never stop that adapting and sharing.
I think that's probably not advice people gave 20 years ago, but we are in a rapidly changing world, and it's good advice for today.
Yeah, fair enough.
And then my last question for you. Can you give me one bold prediction about the future? Something we can bring you back and hold your feet to the fire, see if you were right or wrong.
This one's really put me on the spot. And maybe I'm chickening out with this, but like fashion, what is old will be new. So think of buy now, pay later, for example. That's like the digital version of the layaway from however long ago, right? So I just think whatever was old yesterday will be new again tomorrow in a different version.
I think that's fascinating. I've actually thought that about bank fintech partnerships for a long time, that there's been this period of time where banks, FIs, felt like they had to build technology. And I went, well, did you build your core or your GL? Or, a lot of those were, you may not think of Jack Henry and FIS and Fiserv as fintechs, but they are technology companies that serve financial institutions and have a very similar relationship to what I think a lot of fintechs will end up having with FIs. So to your point, like everything old is new again. We went through a little period where we didn't like it, but now we've realized maybe it's a pretty good way to do business. And I think you'll see that in consumer trends as well as technology trends.
Yeah, and that's a great point that you make, in terms of those technology providers. They are your partners. So
yeah, and they need to have a good partnership mentality.
Yeah, exactly.
Well, Michael, I appreciate your making the time this morning. This was a very fun conversation. We crossed international borders and career industries and the whole thing. But I really appreciate your insights and making the time to share them with the audience.
Hey, Jeff, thanks for having me on the podcast. It was a lot of fun.